often steal the spotlight, secondary offerings play a vital role in the financial landscape as well. Hi everyone, this is CA Shrishti Gosavi and today we are going to discuss about secondary offerings. First, let's clarify what's an IPO. An initial public offering is when a private company offers its shares to the public for the first time. It's like a grand opening for a new restaurant. Everyone's excited to see what's on the menu. Now, let's talk about the secondary offerings. Unlike an IPO, a secondary offering occurs when a company that's already public issues additional shares. This can be done for various reasons like raising more capital or allowing existing shareholders to sell their shares. For instance, on August 18, 2004, a major search engine company offered 14 million shares of common stock at its initial public offering, price of $85 per share, raising more than $1.168 billion for the company. 1 year later, on September 14, 2005, the company issued a follow-on public offering of around 1.41 crore shares of common stock at a price of $295 per share, for an approximate total of $4.17 billion. It is important to note that secondary offering may have widely different reasons for issuance than IPOs. The embed for secondary offering can also involve personal reasons for the ones offering their shares. For instance, in 2013, the founder of a major social media company announced he was selling 41 million shares he held personally in a secondary offering to the public. At a selling price of $55.05 per share, approximately $2.3 billion was raised. The founder stated he was to use a portion of the proceeds to pay a tax bill. The key differences between IPOs and secondary offerings are as follows. Number 1. Purpose. The purpose of an IPO is primarily to raise capital for the company, whereas the purpose of a second offering can either be to raise capital or allow existing shareholders to cash out. Number 2. Dilution. An IPO creates new shares which can dilute existing shares. However, second offerings can be dilutive or anti-dilutive. In a dilutive offering, new shares are issued, while in a non-dilutive offering, existing shares are sold without creating new ones. Number 3. Investor base. An IPO attracts a broad range of investors, including retail and institutional, whereas second offerings often attract institutional investors as they may have limited access for retail investors. A key point to be noted is that second offerings must not be confused with FPOs, follow-on public offer. Second offering is a broader term that encompasses FPOs but also includes other types of secondary offering such as rights issue, bonus issue or open market repurchases. A second offering may not necessarily involve the issuance of new shares unlike an FPO. In conclusion, both IPOs and secondary offerings are essential components of the financial ecosystem. Understanding their differences and implications can help you make informed investment decisions. Remember, whether you are considering investing in a company's IPO or a secondary offering, always do your homework. That's all for today's video. Thanks for watching. I'll see you again in another video.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.